Hi, this is Danielle Woods with DW Augusto Tax Planning. This video is going to go over rental ownership and how it's reported on your tax return. On your screen here is a Schedule E form that is reported on your personal 1040. If you own real estate through a separate business that has its own tax return, like a C Corp or a partnership, it'll look slightly different, but the ideas are the same. So it's important when you have rental property to do a lot of homework before you actually buy it or turn an existing property into a rental. First and foremost, you need to know the value of the property. If you're buying it outright and you're starting to use it as a rental right away, that's pretty easy. We need a copy of your closing statement. If it's a property that's been, say, your home for 5 years and you turn it into a rental property, we highly recommend that you get an appraisal of the property, just a real estate agent in the area, somebody who can do a written appraisal, because the value of the property upon entering it into rental use is very important. The property value has to be depreciated over time. If you are renting a personal home or residential real estate, the depreciation schedule for that is 27 and a half years. So you take the value of the property, divide it roughly by 27 and a half years, and each year you get to subtract from your income that amount of depreciation. We'll talk about that a little bit more when we talk about selling the property. While you have rental property, we highly recommend that you have a separate bank account for the income and expenses of that property. It's very important to keep it separate from your personal accounts. Income is not as simple as you would think. Obviously, rent is income, but you may also be charging pet deposits or a deposit of any kind or last month's rent. Sometimes it's just easier to include any deposits as income and then the withdrawal of that deposit or when you pay it back to the renter as an expense. However you do it from the beginning, whether you just count it as an item on a balance sheet and then remove it from the balance sheet later, it's important to keep consistent. Expenses are listed here on your screen. Advertising costs, travel if you have to drive back and forth to the property to take care of things. Sometimes that property may be far from your home, or you go to the store a lot for supplies or things like that. All of that is mileage. You can't deduct gas or repairs on your vehicle, but it's very important to track the mileage that you have each year for the use of that rental property. The next would be cleaning and maintenance, commissions. If you have a company that is managing the property for you, you might be under commissions or management fees, homeowners insurance, legal and professional fees, paying for your tax return, hiring an attorney to draft contracts, things like that. Mortgage interest should be reported to you on a 1098 form each year from the bank from where you have your mortgage. Repairs, supplies, property taxes, utilities, all of that is pretty understandable. Keep in mind that any improvements to the property, if you buy an appliance, a new roof, new flooring, new carpeting, anything significant like that that improves the value of the property or will stay with the property, those items also need to be depreciated, which means we need to have the date that that expense was spent, the value of it, and how long you think that property might last. On a rental, things like flooring, we usually give it 5 to 7 years. Appliances, 5 years. If it's a new roof, 27 and a half years, the same as the depreciation of the property. So it depends on what you're doing. Sometimes you might buy a property that needs a major rehab. So you have a closing statement from the original purchase, and then you spend, $50,000 rehabbing it. We can just get a chunk amount for that rehab, and we'll depreciate that over 27 and a half years as well. The point I'm making is that rental properties, you need to stay active and keep up with your records. If you have questions, let us know. We need to know this information at tax season each year, and keep in mind that you may be showing a loss on the property initially because depreciation is high and your income might not be as high. That depreciation continues for the life of the rental. When you sell the property, depreciation might come back to bite you. Understand that you will have something called a recapture of depreciation. If you sell the property and you make a profit on it, you not only have to pay capital gains taxes on the amount above and beyond what you paid, but you'll also pay taxes on the depreciation that you have been allowed to deduct all these years. That is capped at 25%. That's often a surprise to rental owners, so we want to